Guys, I was just finishing out this video with one of my sick hand transitions and this happened. This one. And it didn't break, so let's roll the video. Hello guys, if you're new to the channel, my name is Brad and this is The Guided Investor. In life, there are a lot of things that we wish we could be doing more of, like eating chocolate, playing with the dog, and Netflix and chilling. But paying more tax is not one of them. So we're talking about how you can use your super to pay less tax. Now, I'm not talking about paying less tax in the future. I'm not talking about paying less tax on investment earnings or CGT or anything like that. I'm talking about paying less tax now in this financial year from your earned income. And the way you can do that is to make voluntary contributions to your superannuation. Now, there are two broad categories of contributions that you can make into your superannuation: a non-concessional contribution and a concessional contribution. And in order to save tax, you're going to want to focus on the concessional contribution. A concessional contribution is also referred to as a pre-tax contribution, and that is because it can be used to reduce your assessable income so you pay less tax. To understand how this works, you're going to need to understand the basics of superannuation. Starting off with super being a separate tax entity. It is a structure, just like a company is. And the reason why we like superannuation so much is because it's a very tax effective structure. Hey mate. Yeah. Yeah, that's right, yeah. Yeah, I'll reply to that email. Alright, thanks mate. Bye. Anyway, so for those who earn less than $250,000 per annum, the tax rate on a superannuation contribution is 15%. Now, if you earn above $250,000, then you're classified as a high income earner and you're going to get slugged an extra 15%, which basically means your tax rate on contributions is 30%. Now, when you make a contribution to your super, that contribution is going to get taxed at the super rate instead of your marginal tax rate. So the amount of tax that you're going to save is going to depend on what your marginal tax rate is. The tax saving can be as high as 32 cents for every dollar contributed if you're on the top marginal tax bracket but earning less than $250,000. The next logical question to ask is, well, how do you make these contributions? And there are two ways that you can do it. The first way to do it is via a salary sacrifice arrangement with your employer. This is where you ask your employer to allocate additional money to your superannuation rather than putting it into your bank account. The tax savings under this method will essentially be immediate, as your employer makes regular PAYG tax payments to the ATO on your behalf. Now, when you salary sacrifice, those PAYG payments are going to be less as it factors in the salary sacrifice contributions. This method is a great set and forget way to make concessional contributions to your super, because the employer basically does all the legwork for you and there's nothing for you to do at tax time. All you need to do is give your employee the initial instruction and ensure it's set up properly and you're good to go. The second method to make a concessional contribution is to do it yourself via a voluntary member contribution. Under this method, you'll make a transfer from your personal bank account into your superannuation fund via an EFT or BPay. With this method, the tax benefit is received at the end of the financial year when you lodge your tax return. What you'll need to do is lodge a notice of intention to claim with your super fund. This is just a very simple form which tells your superannuation fund that you'll be claiming a tax deduction for the voluntary contributions made in that financial year. Then when you're filling out your tax return, you just need to remember to include the contributions as a deduction. Now, if you use an accountant to help complete your tax return, then just let them know what contributions you've made. The benefit of making these contributions yourself is that you can do it at any time and as a lump sum, whereas with salary sacrifice, it's normally a predetermined arrangement. Also, under this method, you will likely get a tax refund after lodging your return, and that is because your PAYG is not adjusted when you make the contributions yourself. However, you're not guaranteed to get a tax refund because it depends on what other taxable income you have and how much PAYG you've paid throughout the year. So now that you understand how superannuation works and you understand how to make a deductible contribution, let's look at the pros and cons of this strategy. You will potentially save tax. The amount of tax you save is going to depend on your income and the size of the contribution. Once inside superannuation, the money will be invested to grow your retirement savings. Any investment returns will be favourably taxed at the super tax rate. Now for the cons, there is a limit on how much you can contribute to your superannuation. every financial year as a concessional contribution. That limit is currently $25,000 per annum, but keep in mind that any employer superannuation guaranteed contributions form part of that cap limit. Once inside superannuation, that money is generally stuck there for your retirement, unless you're contributing under the First Home Buyer Super Saver scheme, but I'll touch on that in another video. So you're not going to be able to get access to that money until you reach your preservation age, which depends on your date of birth. If your assessable income is $20,000 or less, then this strategy is not for you. At this level of income, you basically pay no personal income tax anyway, so there's no tax benefit of making the concessional contribution. Instead, you'd be better off considering making an eligible spouse contribution or a government co-contribution. And again, I'll touch on these in a future video. Once inside superannuation, your funds are going to be subject to investment risk. Now, the amount of risk that they're subject to is going to depend on your superannuation's investment strategy. So make sure you understand the investment strategy before putting extra money in. So I'm a big fan of making extra contributions to your super, not just for the tax savings, but also for the long-term retirement savings benefit. However, as I hope you can see, this strategy is not for everyone, so make sure you do your homework before making any additional contributions. Thanks for watching, guys. I'll see you in the next one.